Hi, I'm Steve, and in today's video we're going to talk about restricted stock units, some important tax considerations, and some strategies to help you get the most value out of your benefit. So stay tuned. So what are restricted stock units? RSUs are simply a form of stock-based compensation that a company will award its key employees, managers, and executives with shares in the company's stock. You see, they want to keep you around. They want to reward you for the work that you've done, but they also want to create an incentive for you to grow with the company and grow the company, because when that happens, everyone wins. But the stock isn't yours day one. You see, there's a couple conditions that have to be met. One, it's usually time-based. Second, it could be performance-based, or it could be both, known as a double trigger event. But let's talk about the first one, time-based. That's known as a vesting schedule, simply time between when you're granted the stock and when you're delivered the stock. The performance-based condition is mostly done in private companies where they're waiting for a merger, an acquisition, maybe even going public with an IPO. So we're not going to focus on that in today's video. What we will do though is talk about the time-based condition known as a vesting schedule. There's a couple different forms of vesting schedules. The first could be what's called graded, which is what you're seeing here on the board. A little bit of the stock is delivered to you on anniversaries. That's known as a graded. There's all different types. It could be as long as 6 years, but the more common is something around 3 to 4. The second is called a cliff, which is just saying you have to wait the full period of time before you're given all of the stock, nothing in the interim. So it's really important for you to look at your company's specific plan to see what your schedule is and when those shares will be delivered to you. Let's now talk through a simple example so you can see how this all works. Here we're saying the company has granted you 1,000 shares. After that first anniversary where the shares have vested, they'll now deliver that first lot to you, the 250 shares, which is reflective of 1/4 or 25% of this example. At each following anniversary, you'll get the next 250. So after 4 years, you'll get the full 1,000. At this first vesting, when the 250 shares have been delivered to you, you have two options. Option one is, do you sell them? Do you sell them for the value known at that date and time and treat it like a cash bonus? Or do you continue to hold them? Maybe you think the share price is going to increase, so you're willing to hold on to them and wait. When you sell them in the future, they'll either be short-term or long-term capital gains based on how long it's been. Has it been a year or more from vesting? If so, those are treated as long-term capital gains. If less than a year, then it's short-term. To help you think through this and to lay out some considerations, I came up with 5 things to think through. First is, what is your company's trading policy? Are there blackouts, restrictions, or is it open and you can sell it whenever? Second is, what is your thought about the company's share price? Is it going to increase in value? Is it going to decrease? Are you okay writing it out? Third is, what is your cash flow needs? What are your projected cash flow needs? Are you going to need that cash? Fourth is, what is your overall plan? Thinking of it this way is, how many eggs have you put in the basket of company-related benefits? So on top of your wages, your 401k, your health insurance, your life insurance, now RSUs, do you have too many eggs in that one basket, and should you be diversifying? And fifth is taxes. We need to consider those. So when the shares vest, at that point in time, they are now considered compensation or wages to you. We can have amounts taken out to cover the taxes, but we need to be considerate of what is coming out. So here, when we think through our normal paycheck, our wages, we've elected how much is going to come out for federal and state reasons. Based on our W-4, we're saying out of each paycheck, take out this and submit it to the IRS and the state as applicable. In our example here, let's say our compensation and RSUs put us in a high bracket. Maybe we're in the 35% bracket, one of the higher brackets. And when it's all said and done, maybe those are right on track. Maybe we have a small balance due or a small refund. They're right on track though, and they're appropriate. However, when we add the RSUs now on top of it, those are treated a little different. The IRS says these are called supplemental wages or supplemental income, and then instead of being withheld at the same rate as your wages, they're withheld at 22%, a flat 22%. So when these vest and they're included in your paycheck, 22% is coming out for federal and the others appropriately. But what you'll notice here is there could be a large discrepancy. Your withholdings are appropriate for your wages, but now when we add the RSUs on top of it and they're only held at 22%, that creates a discrepancy. The good part of this is withholdings are coming out. So this 22% doesn't have to come out of your pocket. There's something known as a net settlement. So some of these shares are being sacrificed or sold behind the scenes to cover the taxes to pay that 22%. So at least the RSU may be partially covered. However, if there is that discrepancy, that shortfall, you're going to have a balance due when you file your tax return. So you are going to have to either liquidate more or pull from savings, pull from other accounts to pay this eventual tax balance. So it's really important here that you realize that there's a discrepancy. If the RSU, the total value of the RSUs exceed $1 million, now instead of a flat 22%, it's at 37%. That's in line, so we wouldn't have such large discrepancies, but that's only after the RSUs exceed $1 million. In summary, you can see there's a lot going on here. We want to help you. So if you don't have a plan or you're not working with an advisor, reach out to our team. We'd be happy to talk through this, lay out a schedule, lay out a plan, help you think through how you can get the most out of your benefits. And if this has sparked some interest, check out our blog, check out our website, check out our podcast, our YouTube page. There's a lot here that we try to write about to show you that there's options, there's strategies, there's ways to make your future better. You just have to act on it. And if we can help you, we're happy to.